The second largest bank failure in United States history has just taken place. Now, I know you're probably thinking, this is old news. Silicon Valley Bank collapsed 2 months ago, right? That's right, but this is a new second largest bank failure because it's bigger than Silicon Valley Bank. This time it is First Republic Bank. Over the weekend of April 29th, regulators were preparing to seize First Republic Bank and trying to find a buyer. And find a buyer they did, as Chase decided to take the bait, claiming that they fixed this portion of the banking crisis. So why did First Republic Bank fail? More importantly, who is next? And finally, what can you do to keep your money safe? So first, what did First Republic Bank do? Well, you may be shocked to hear this, but they did something absolutely insane, something crazy. And that thing they did was they decided to be a bank. That's right, First Republic Bank took your dollars that you deposited there and lent them out. That's it. That's what First Republic Bank did that got them in trouble, and that's what all banks do. Nothing crazy here. Well, I mean, yes, crazy, but not crazy relative to every single bank. Now, it is absolutely true that First Republic had some decent exposure to jumbo mortgages. Those were bad investments that did make things a little bit more difficult for them. It is also true that First Republic had a decent number of clients that were above the $250,000 limit for FDIC insurance. But again, that's not what got them in trouble and what ultimately caused them to fail. What caused them to fail is actually just being a bank. So what did they do that caused them to fail? Well, here's exactly how banks work. Number one, they take your money as a deposit. Now, at this point, you are a lender. They owe you those dollars back. Just exactly the same as when you swipe a credit card. When you take out a loan, you are a borrower. You owe those dollars back. When you make a deposit to the bank, you're actually the lender. They owe you those dollars back. Now, if the process stopped there, the bank would still collapse because they don't have any way to make money on that. They've got to keep your dollars. They've got to keep the lights running. They've got utilities to pay. They've got employees to pay, real estate to pay. They've got all these expenses. And so if they don't do something with your dollar to make money, then they don't have a business. And so after they take your deposit, they usually make a loan with those dollars. They'll take your dollar, they'll loan it out to somebody else. This might go as a mortgage. So that dollar gets lent out to somebody else to allow them to buy a house. It might be as an auto loan so that somebody can go buy a car. It might be as a credit card loan, or most of the time, it's a loan to the United States government. It's also worth noting that these loans don't have to be created. They can also be purchased. And so instead of creating a new loan, taking your dollars and lending it out as a fresh loan, they'll look at the marketplace of all the loans that already exist. They'll take your dollar and they'll buy one of those loans. And so that loan that was floating out there before was money going from Johnny and he was going to pay back Sally. And now since your bank bought that loan, now Johnny is going to have to pay back your bank. Now, at some point, you're probably going to go and you're going to take your money out of your bank account. And so at this point, the bank may have some cash reserves to allow you to take your money out. But if they don't, they might have to sell an asset that they already have in order to free up the cash to let you take your money out. Under normal circumstances, this isn't a big deal because they have a pile of assets, and so they'll just sell one of their assets that they're not at a loss on to free up the money so you can take your cash out. That asset that they have is a loan, so at some point that loan will be repaid. They'll be filled up with cash again. They're still not just going to sit on it, so they're going to re-loan it out or use it to buy another loan. The problem with banks happens when, number one, too many people try and go get their money at the same time in the case of a bank run. Now, again, under more normal circumstances, the bank can theoretically just sell all of their assets, and if they've got $100 that's trying to be withdrawn, they can sell their $100 worth of assets and meet all those withdrawals. But right now, asset prices are a lot lower than they were when those assets were purchased for pretty much every bank out there. And so when a bank run does happen and deposits do come out of the bank and they do have to sell their assets, they're selling something for $70 that they bought for $100, meaning they usually don't have enough assets to cover all withdrawals. By the way, if you would like to learn professional strategies on how to position yourself to profit from company collapses like First Republic Bank without taking taking on excessive risk? That's exactly what my professional options strategies course will teach you. That's linked with the Heresy Financial University link in the description below. So why in the world are asset prices lower right now? Banks took your money, they bought an asset like a loan, and now that loan is worth less than it was when the bank bought it. Why is that the case? Because it wasn't just Silicon Valley Bank, it's not just First Republic Bank, it's all banks. Well, it's because interest rates rising push asset prices down. This is true of both stocks and bonds. It's also normally true about real estate, unless of course there's a huge supply-demand mismatch in real estate. And given the fact that the Fed has been pushing up the Fed funds rate at an extremely fast pace, which has resulted in the interest rates across the entire yield curve rising to levels they haven't been at in years, we have seen asset prices from stocks to bonds both take a huge hit. So first, why do rising interest rates cause stocks to fall? Well, first of all, it's a question by investors about where do I put my money to get the best risk-adjusted return? And that caveat there, risk-adjusted, is very important here. Because let's say you could expect an 8% return in stocks. Well, what's the risk? Well, in a bad year, the stock market might go down 10, 15, 20%, which is exactly what it did during 2022. And if you're invested in individual stocks, then the risk is that company actually fails and the stock goes to zero. And in the case of company bankruptcy, the shareholders don't get their money first. If the company has debt, aka bonds, those bondholders get their money first. And if there's anything left over, that's when it goes to shareholders. And so the risk-adjusted return for stocks may be worth it if the alternative is 0%. If you're looking at two options and saying I can either earn nothing or I can risk it to earn 8%, maybe that's worth it. But when you can give your dollars to the US government for 1 year and earn 4.9%, or even better, you can give it to the government for 6 months and earn over 5%. Suddenly, that 8% expected return from the stock market doesn't look so good anymore. Because what is the risk of investing with the US government? Well, basically, it's just that the Republicans and the Democrats will hate each other so much and argue so much that they won't come to an agreement on raising the debt ceiling. Is there a risk of that? Sure, but the probability of that happening is most likely a lot lower than the stock market, let's say, just moving sideways for 6 months or a year. This means that the risk-adjusted return for bonds looks much more attractive than stocks when interest rates start to go up. And so it starts to suck capital away from stocks and go into bonds instead. As that happens, it becomes a little bit of a self-fulfilling prophecy and it pushes the stock market down as more people sell. Add on to that the fact that many companies that are publicly traded are extremely over leveraged. And when interest rates go up, that increases their debt service cost. And so it makes companies less profitable, makes it harder to do business as the credit crunch increases from higher interest rates. And so that means stocks are not going to perform as well because their earnings are not going to be as attractive. So all around the board, rising interest rates mean stocks are in the gutter. But we know that banks don't primarily invest in stocks. When you deposit money and they take your dollars, they're not throwing that into the stock market. Most of the time, they're just loaning that out again. They're buying bonds. So why would rising interest rates be a problem for bonds? Well, essentially, it's because when interest rates go up on new bonds, on new debt, that means any debt that already existed, the price of it will go down. And here's why. If I've got $100, and I'm looking at everybody out there because I want to make a loan. I'm looking at all the borrowers and all the borrowers are saying, I will borrow at 5%. That means I can take my $100, I can loan it out to anybody and get 5%. Now, if you've got one person in the crowd who's saying, I will borrow that money at 2%, am I going to loan my money to them? No, I'm going to loan my money to somebody else for 5%. Now, as soon as I loan that $100 out and expect 5% back, so $105, a contract is created. That contract itself is worth $105 because in 1 year, I'm going to get $105. So it's a piece of paper that is worth $105 in 1 year from now. So the question is, how much would you pay for that piece of paper that is worth $105 in 1 year? And the answer is, if you could take your $100 and loan it out to anybody for 5%, then the most you would pay for my piece of paper that's worth worth $105 is $100 because then you get the exact same return. But let's say interest rates go up even more. I still have my paper and my paper is only worth $105 because I already loaned it out to you and we already created the agreement that you're going to pay me back $105. But if interest rates everywhere else go up and somebody else can loan out money for 6% and create a new piece of paper that's worth $106 and only have to lend out $100 to do that, then I won't be able to sell my paper for $100 anymore. The value of my paper will go down to $99 because if I want to be able to sell that paper, I'm only going to be able to sell it to somebody if they can get the same return from it that they could get from everybody else. And so to me, it's still worth 5%. So if I can sit on it and hold it, I'll still get my 5%. But if I have to sell it right now, I'm going to take a loss on it because to sell it right now, it's only worth 99. And that's exactly the position that banks are in. If they're forced to sell their assets, they're taking a loss on them because those assets are worth less because new money is being lent out for much more today than it was when those loans were created. So now let's look at the specifics of what happened to First Republic Bank and what caused it to fail. One issue was its jumbo mortgage portfolio. The reason they made these low interest jumbo mortgages was to attract high net worth customers. Seems like a solid plan. Offer a product for wealthy people. Those wealthy people will deposit a lot of money in your bank and then you'll be able to take a lot of money per customer and loan that out and make money on the spread. Why would you want high net worth clients? Well, it's because they're more profitable. If you have two examples where your bank has, let's say, $100 million in deposits, would you rather those $100 million in deposits come from 1 million people with $100 in their bank account or 100 people with $1 million in their bank account? From a business perspective, it's going to be much more profitable to go the high net worth route because you have less customers to deal with, less overhead, less infrastructure and staff needed in order to service these clients. You still have the same amount of money either way that you can take and you can go make money on. And so it's going to be more profitable. That is until banks start collapsing. Because suddenly when banks start collapsing, then you have people looking and saying, well, why is that bank, let's say like Silicon Valley Bank, collapsing? And you realize, well, the bank's not doing anything crazy, but if everybody starts to take money out, then the bank does fold. And whose money is safe when the bank folds? Only those who have less than $250,000 in their account. So Silicon Valley Bank was made up of a ton of deposits from ultra high net worth and corporations, companies, VC backed that had millions of dollars in their account. And they were saying, look, we don't want to be at risk of losing this. The government's not going to bail us out, so we need to move our accounts somewhere else. And so clients at First Republic looked at the exact same situation and said, we're in the same boat. Except with First Republic, there's even less of a chance that you're going to get Jerome Powell and Yellen standing up there and saying, hey, this bank failure poses systemic risk, like Silicon Valley Bank. At least with Silicon Valley Bank, you had extremely wealthy donors and you had rich, powerful companies and leaders of these companies and investors in these companies who were going to their politicians, who were going to the policymakers and saying, you better bail this out because this is systemically important. You don't have that at First Republic. But a bailout was able to be orchestrated nonetheless. JP Morgan Chase finally took the plunge and decided to buy First Republic. It's important to note here that FDIC couldn't do this. Straight from the FDIC's website, the Deposit Insurance Fund is worth about $128 billion. That equals 1.27% of what would be needed to bail out the deposits of all banks. Now you might be thinking, but wait, that doesn't matter because we're talking about just First Republic here. We're not talking about all banks collapsing. Well, First Republic Bank alone had $92 billion of deposits. That's a pretty big chunk of change for an FDIC with only $128 billion. And so FDIC was trying to get a bank to buy First Republic so they didn't have to do it themselves. And in fact, on March 16th, 11 of the nation's largest banks put together $30 billion and gave it to First Republic. That cash injection ultimately was obviously not enough. The reason why Chase got it is because they basically offered to buy the entire bank, so it was the best offer on the table for the FDIC, although it wasn't free and clear. JP Morgan and FDIC are going to be sharing in the burden of the losses as well as any recoveries from the mortgages for single families and commercial loans. Unfortunately, this highlights a problem that many regulators, many politicians are pointing out, even if they have the wrong solutions. Elizabeth Warren tweeted, "The failure of First Republic Bank shows how deregulation has made the too big to fail problem even worse. A poorly supervised bank was snapped up by an even bigger bank. Ultimately, taxpayers will be on the hook. Congress needs to make major reforms to fix a broken banking system." So good job for pointing out the problem. Bad job for suggesting more of the same that caused it in the first place. Because the reality is more banks are coming next. These will be small regional banks. All banks are suffering major losses right now from rising interest rates. This means if any bank gets a bank run, they go under. But most losses that banks have right now are unrealized, meaning if they just wait until that loan gets repaid, they get all their money back. So it doesn't matter as long as they don't have to sell early. But that's not the case with many regional banks, which are already experiencing more stress even after the First Republic purchase by Chase. Most of this comes from the commercial real estate crisis. Commercial mortgages are all variable interest rate. They have balloon payments. $1.5 trillion of commercial mortgages are coming due within the next year and a half. And a lot of that is held at regional banks. These borrowers, number one, cannot afford the balloon payments. Number two, they cannot afford the higher interest rates on the adjustment. Number three, they can't afford to refinance because the new interest rates on the new loans are much higher. Number four, because of all the empty office space and all the other problems with commercial real estate going on right now, they can't sell them for what they bought them for. And so a good chunk of $1.5 trillion worth of commercial mortgages are going to be defaulted on, which means that those unrealized losses at banks are going to very soon turn into realized losses. And when they say we've got this much in assets, as long as we wait until it matures, we'll get it all back, boom, we'll suddenly go down and show much smaller assets on their balance sheet, which means, unfortunately, even more consolidation to the big banks, because the big ones are the only ones deemed systemically important that are too big to fail. And so yes, Senator Warren points out a crazy problem that we are having everything consolidated to massive banks, and that ultimately taxpayers will be on the hook. But guess what? They wouldn't be on the hook if there was no such thing as too big to fail. Congress did that. The government did that. Too big to fail means the government will rescue them. And if banks were allowed to fail, you would stop the excessive risk taking with your money. The answer isn't more government and to socialize losses as well as socializing gains. The answer is to privatize everything and allow failure to happen. But you and I can't control what they do on Capitol Hill. So how do you protect your money? Well, unfortunately, the solution that is good for you is bad for the system because of the way that they've done things over on Capitol Hill. But we can't control that. What is the best thing for you to do with your money? Number one, if you have money in a single account as a depositor over $250,000, get it out. It is not safe. What are the chances that your bank is going to be considered systemically important? If it's not one of the big six, it's not. So if you've got cash in excess of $250,000, spread it out between banks so that you don't have cash in excess of 250 grand. Now, let's say you have a net worth that is higher, so maybe you only have 5% or 10% of your portfolio in cash, but it's still a few million bucks. That'd be absolutely crazy then to try and spread that out among 10, 20 different banks just so you can get under that 250K limit. Option number one is gonna be something like a T-bill ladder, because when you give your money to the bank, they're just giving it to the government anyway, so just bypass the middleman, get rid of that risk, and then you're left with just the risk of the government defaulting, which is the same risk that you're taking on by putting your money in the bank. So just skip the middleman and go direct to the source. With a T-bill ladder, you're going to get all the liquidity that you need anyway, because basically every month you're going to have a significant chunk of your change coming due that you'll roll over into the longest maturity there. And so you don't really have to worry about if you need to access it all at once, as long as the amount that's maturing every month is enough to cover whatever might come up for that month. If that sounds too complicated for you, or if you don't like the fact that you might have to wait 4 weeks or 8 weeks for some of your money to mature, you could always go into a money market fund. Money market funds have significantly less risk than many banks do right now because money market funds have never invested in the long-term government bonds. You can put your money in a government money market fund that's only invested in the very short-term government bonds, and that way they don't have the unrealized losses that many banks do. Further than that, money market funds don't have the same expenses that banks do, and so they're able to operate as a middleman between you and government bonds and just take a very small spread, and so then they're able to offer you all the liquidity that you need and the higher rates that you need without taking on the risk of putting it at a small regional bank. And of course, if you're doing this with over 5 to 10% of your net worth, I would personally recommend putting a big chunk of that into gold and Bitcoin. I'm not a big fan of holding on to a ton of cash in environments that can switch over to inflationary environments in the blink of an eye. So T-bill ladders, short-term government money market funds, gold, and Bitcoin are the things that I would suggest to do with your cash needs instead of keeping a ton of cash in small banks for low yield. And of course, become a member at Heresy Financial University, linked in the description below, where you will learn everything you need to know about growing and protecting your wealth. As always, really appreciate you guys. Thanks so much for watching. Have a great day.